Hello, and welcome to this month's Market in 2 Minutes. This is Michael Moriarty. Wanted to touch on something that many are probably observing. You may have opened your January statement or gone onto the portal and seen your fixed income portfolio down 3 or 4% for the year, and maybe asking, should I even own fixed income? We would offer a couple observations. One, the 10-year Treasury yield has increased to about 2%. That's up from the recent lows of 50 basis points or a 1.5% increase. When we look at previous rate increase cycles going back post-financial crisis, 1.5% is about at the high end. So while we may, in fact, have more pain in front of us, we would suggest that likely you've already worn a decent amount of pain in your fixed income portfolio, or probably toward the tail end. The second point we'd make is reflected on this slide. Namely, pension funds calculate what is known as their funding ratio, and it's simply how much they have invested currently as a function of what the current discounted value of their future liabilities are. And you can see coming out of the financial crisis, pension funds were largely over-risked. And so when the stock market fell, their portfolio fell, and therefore their funding ratio fell. You can see at various points, they only had 70 or 75 or 80% of their liabilities. The good news for them is that with the rally in risk markets over the last decade, they can breathe a bit of a sigh of relief. And now that ratio is back to 100%. And so what we're observing is that pension funds are de-risking because they can afford to. They're getting out of equities, the volatile equities, and they're getting back into the fixed income markets. And so the pension funds and other similar institutions might continue to provide a very strong bid or demand for Treasury and other fixed income paper to support those yields and perhaps provide a buffer from further increases and therefore losses in your portfolio. Thank you for listening to this month's Market in 2 Minutes.